Kenya stock market ended 2025 52% higher, and it's adding to that momentum with its first initial public offering in 11 years. The Kenyan government is selling 65% of the shares in the pipeline monopoly KPC, aiming to raise about $824 million. 11.8 billion shares are on offer between the 19th and the 19th of January and the 19th of February. The price at around 7 US cents a share. Keep that number in mind because we'll come back to it in a moment. These shares will start trading on the 6th of March. This is the only pipeline operator in the country that moves around 14 billion litres of fuel every year. It reported a 65% rise in pre-tax earnings in its last fiscal year to over $127 million. The offer's pricing, however, has raised questions about what the proper value of Kenyan Pipeline really is, especially at a time when the Kenyan government is struggling to raise external financing. Valuations that we have seen on this program, they range from less than 4 US cents per share to around 6 US cents per share, depending on the investment bank one looks at. Regardless, however, of what price the firm shares settle at when they start trading in March, there are more fundamental questions to examine. For example, how big a risk is it to Kenya Pipeline's revenues once countries like Uganda no longer need to import refined fuel? That's why I started my conversation with Wesley Manambo of Standard Investment Bank.
When you think about Uganda, the oil that they've realized, in as much as it is crude, refining is quite a key process. When you use the playbook that happened in Nigeria in terms of setting up the Dangote refinery, it's a playbook that took a lot of time and a lot of capital. And looking at the play in terms of the Ugandan government thinking about crude is to set up a pipeline to export it outwards, then earn revenues from that, and then work on the import model. So in the near term, the risk of export sales declining from the likes of Uganda picking up production seems quite on the low. But then if they do show aggressive interest of setting up a refinery of their own in Uganda, that will be a key play that will fundamentally change the outlook of the business. But as is, one of the main risks remains the Going Green initiative.
With respect to how investors should be thinking about this, because you've essentially argued that the value of Kenya Pipeline lies in the beholder, depending on the investment horizon that you're looking at. Investors with a long-term horizon over 7 years, you say, that warrants a buy recommendation at the price that you've implied here of around 8 shillings a share. For investors who are looking at cash flows, right, and how the company performs relative to peers, you put up a hold recommendation. That's the house view at SIB. But for investors who are focused on dividends, right, they will look at this and say, well, in the past, we've seen instances where KPC has paid out, over 80% of its dividends straight back into the government. But now they're saying that, look, they're going to change their dividend payout policy and have a minimum of 50%. At those levels, is it still an attractive proposition?
When you think about it from a valuation point of view, as you've correctly put it, it does give mixed investment proposition to different buckets of investors. Thus, we believe from a house view that essentially the value lies in the eyes of the beholder. From a dividend perspective, they did slash their dividend payout ratio from an average of about 95% to the minimum of 50%. But key to note is they do have a very heavy pipeline in terms of projects that they need to launch, which brings into mind the fact that they need to hold some cash back so that they can focus on these capital heavy projects. That's one. So for a dividend-oriented investor, we believe the market offers better value proposition from a dividend play, and the opportunity cost, looking at the outlook of the business from a dividend vantage point, tends to be very expensive.
When you talk about the projects that a company needs to invest in, and I know you mentioned some of them a little earlier, there's the revamping of the storage that used to be the Kenya Petroleum Refinery storage facilities down on the coast. They've been putting a fair bit of money into this fiber optic network. What else do they have on the horizon that requires them to have a fair bit of cash held back?
They're looking at setting up another pipeline from Mombasa to Nairobi. That's around 450 kilometers, what will be known as Line 7. But when you think about it from a perspective of capital expenditure, this pipeline from our estimate is it will cost somewhere between $1 to $1.5 million per kilometer, which is in excess of 57 billion just to set up that pipeline. Again, if they are to go into the LPG storage and transportation, there's another in excess of 50 billion in terms of capital expenditure that will need to be set aside to channel this project. To light up the fiber optic cable, which is dark at the moment, that's another 800 million. But when you think about it, something like fiber optic cable is able to pay back in a period of about 3 to 4 years when you look at what other tier 2 license providers are doing in the market in terms of pricing. So all these projects are essential for the going concern of the business and from a profitability point of view in the long run. But then in the short to medium term, investors who are looking at this asset as strategic, they really have to tighten the belt from a point of expecting more cash to go out towards these projects and little to come in terms of dividends.
What about the pricing risks that come in with the tariff structure that it operates under? Because Kenya Pipeline doesn't set pricing, right, on what it essentially charges its clients to move product through the pipelines, right? And that tends to be adjusted on an annual basis by the energy regulator here in Kenya. EPR rate moves up by around 2%, 3% every single year. To what extent is that going to be a problem for them, at least in the medium term? If, for the sake of argument, something that we see in the electricity space happens in KPC. In the electricity space, we've seen situations where the tariffs are not reviewed for multiple years, or the review process is pushed forward. If something similar happens with Kenya Pipeline, does it still remain as an attractive buy?
That would have been a very key risk, but from our understanding of the business and the regulators' play, capital expenditure is a very key consideration in terms of tariffs review. And looking at this considerable pipeline, looking at 57 billion here, 50 billion here, 800 million here, and these projects are from a period of 1 to 4 years. There's a way that tariff calculation is done for the midstream to allow them to earn back the capital expended. So from that perspective of these projects and the actualization of them, we expect to see an upward revision of tariffs from a regulatory standpoint, and management has given us an understanding that from their proposal and ability to lobby, they have quite a good standing from a capital expenditure point of view to see an upward revision of tariff. But in the unlikely event that tariffs are not reviewed upwards correctly to really see them earn back the capital expended, that becomes a very fundamental key issue, which will not only affect the ability of the business to maintain positive cash, but also pay out dividends and also remain as a going concern as a whole.